Right across the board now, tech not hedging the downside in the recovery trades today. David Neuhauser is the managing director at Livermore Partners. And David, I'm looking forward to our conversation, continuing it as we have been for some time. Let's start with the bearish tech side, because it seems like you think there's plenty more to go here in terms of downside for the NASDAQ.
Yeah, thank you for having me, Oliver. Tech's obviously been the place to be this year. It's been a true tale of two cities in terms of where the market's going, the economy, and of course, tech is versus the value investors universe. So I think at this point you've seen just a massive liquidity push into tech. Valuations, of course, are skyrocketing. You're starting to see that come off pretty significantly, and I think the road ahead is going to be more troubling to continue to see those type of returns.
David, what's the most compelling sign that investors will give up on their quarantine trade? What's the evidence that they're around to, I've been calling it the sequel, that the sequel's not going to work this time?
Yeah, I think it depends on how you look at where you are, right? We're getting all these different cross currents happening in terms of news flow. So we had the election that we came through at this point, which gave a lift to markets. And then, of course, you had the view of a vaccine, hopefully in the near term, that's very effective from Pfizer. And, that took the high-tech valuations down a bit as people look for reopening. But as you're seeing just, days after that, you're seeing reality hit, right? And as reality hit, you're seeing New York shut down, Chicago potentially shutting down, and other areas due to quarantine. And I think that has a real effect on the global economy. And thus, you're getting that shift a bit back into some buoyancy into tech and then back out of value. So it's a complete cross current. And I think what's going to have to happen is you're going to look forward and think, what are the dynamics at play? What's truly going to happen? What's going to be the narrative that takes hold going forward? And not so much what's been the narrative of 2020.
David, correct me if I'm wrong, but the way you had your portfolio positioned, enjoyed a lot of the tech downside, enjoyed the selling that we saw in the early sell-off. But how do you express that view now, and how have you retooled the way to bet on this? Because obviously the valuation part has not been the trigger, right? The valuation just kept melting up and higher and higher and higher. So if we are now getting a more fundamental kind of trigger through a spike in COVID, or a fundamental trigger through a spike in yields if we get a vaccine, it seems like either one could be bad for tech and the market as a whole. How do you position for that, though? Do you want to sell the companies you think are exposed to weakness, or do you want to buy the companies and potential reflation style trades? I mean, how do you get ready for such an event?
Well, I think it depends on your time frame, right? So I think some of the companies that have obviously seen this sort of massive valuation, to me, has just led to a bubble that's been brought on by the Fed and liquidity. I mean, to me, there's been a bubble forming in the equity markets for some time. And the pandemic, unlike almost any recession I've ever been a part, has actually accelerated the move higher in valuations for tech stocks and actually pushed down value. So if you're a value manager today like me and with Livermore, this has been just an ugly time to be holding those investments. I think if you look out though, and again, that's why I'm saying duration matters. So if you look out over the next 2 to 5 years, I have a hard time thinking that tech can continue to have no bounds and valuation multiples continue to expand. I think a lot of that comes from there's been this huge demand pull in tech, right? The whole digitalization aspect of business, online, cloud computing, everything, all the fancy catchwords that you hear today. That's been the trend for the past several years. Again, multiples have been expanded due to low rates and policy. That's continuing. I think that's creating the bubble. Eventually, I think you're going to start to see that trade run its course. And ultimately, you'll look back at this time period and think this was a great time to be exiting those areas and to be focused on value.
Now, part of that potential for value to perform depends on the economy to perform. You've been talking gold with us for a while, David. You're on the right side of this trade on the way up. It's been struggling the last couple months, so I'll keep pressing you on the bull case here. At what point does the chart you look worrisome. I mean, this thing just can't take off. As soon as it started to move post-election, all this stimulus talk blasted on the vaccine news. What do you think about gold right now, David?
Well, again, I think gold looks to be in a range, right? It's basing. I think that's normal for it to hit a high and kind of base. That to me is still a bull move. I think the key is, as you look forward, what ultimately occurs. So if you see a vaccine take place, right, and you see a reacceleration of global economic activity, is Fed policy going to remain constant? And is that sustainable? And if so, that eventually tells me we're going to see potential for not just inflation, but even hyperinflation. And with that, gold will at some point accelerate and break out. I also believe in a weak dollar trade, as you know, for some time. I think the best trade you could have today going forward for the next 5 years is a short dollar trade. And, at Livermore, we're doing that. And we've done that, obviously focusing a lot on resource names. Gold and some of the miners, to me, have been the place to be. But, they're still trading at very interesting valuations today. So to me, that means you should continue to be accumulating on weakness. And I think the upside remains very buoyant for areas within mining and for anything tied to a weak dollar. So that's my theme. And then, of course, we look, as you know, with Livermore at special situations so that we can extract value. And, sometimes that comes in a year or less, and sometimes that takes 3 years. So I'm trying to be patient and be very specific to situations we think will match up and create very strong returns for us on a weak dollar play in the coming year.
So weak dollar, higher gold, that's basically betting that the last 3 months has been a blip, basically, with the strong dollar, firm dollar, weaker gold. And then the tech bear move is betting that the period before the last 3 months doesn't come back. So you're kind of betting basically the gold and the dollar trade are the way this market was from March until August, but that was also a tech positive trade. So the distinction here is that you're saying something's going to change that's going to cause tech to be negative despite a return to the trends that worked for gold and the dollar in your favor during that period. It seems like that distinct part is the inflation component. So the last point here, David, is when we've got all this money that's been pumped into the market, the Fed doing everything that it did, policy doing all they did the last 6 months, and we're coming up shy of inflation still. I mean, how long do we need to give this theory to play out?
Yeah, I think a lot will end up also being, what occurs over the next year and two. Because like you said, you're not going to get inflation when you have a deflationary wave. I mean, today you have this perfect example of deflationary events that are occurring, right? You're seeing lockdowns again globally. That's causing economic contraction, not expansion. So when you get that, it's a deflationary environment. You're not going to make money in trades like that when there's deflation, right? You're not going to own banks with low net interest margins. You're not going to be able to own energy assets today for the most part, right? That's not where you're going to make your money. You're going to make your money by looking again at very specific situations tied to that weak dollar trade. And when that occurs is when, like I said, looking forward, what's the next big leg to happen moving forward? We could be hunkered down for some time, but I think the theory behind that is if that happens, we are going to have to see more and more stimulus come out of the government. And ultimately, who pays for that stimulus, right? So there's a knock-on effect from that stimulus. And that could be a year out, 2 years out, or 10 years out, Oliver. And that's what I'm saying is that at some point, someone's going to be paying for all the stimulus. And as the stimulus comes along, you're going to see the dollar continue to weaken and grind down. Okay. And if that stimulus finally starts to gravitate, of course, and hold the economy, then obviously that's going to be a boon for inflation at some point to really dig in. And when that occurs, you'd want to be long things like gold and the dollar. And what you don't want to be is long technology, because at that point you're going to see a stronger yield curve and higher rates, and that's kryptonite to tech stocks. Okay,
all right. So we've had one or the other. We've had stimulus or growth. We haven't really had both yet, which is the inflation ideal. You need the stimulus and the real economic growth. David, always good to catch up. Thanks for walking us through your view. Mr. Neuhauser.
All right, thank you.
Thank you. He's the managing director at Livermore Partners.